Hello and welcome back everyone. Today's webinar is going to be talking about the trading chart patterns. So in forex trading, there's a lot of chart patterns that we could use, and they're very useful. So let's get started. So we're going to mention the chart patterns, what they are, and then we're going to talk about them in detail. So the first chart pattern is trend channels. Then we have triangle patterns, symmetrical triangles, head and shoulders, inverse head and shoulders, double tops, double bottoms, wedges. Okay, so the first one is going to be trend channels. So a channel is basically when price is in a trend, so it's either a bullish or a bearish trend, like we can see here, and it stays there for too long, price will create a channel. There's two types. There's an upwards channel and a downwards channel. Okay, so we're going to cover upwards channel first. When price is in a bullish trend and it creates higher highs and higher lows, so it creates higher highs and higher lows, there's always going to be a pattern to it, so it's always going to be going up. So in that way it creates a channel. So we're gonna see an example soon. When that occurs over a period of time, a channel is going to be created, like I said earlier. Okay, when the channel is created, there's going to be support and resistance levels. So this is what a channel looks like. So as we can see here, just give me 1 second. So as we can see here, price is in a bullish trend, so creating higher highs and higher lows, and we keep doing the same thing. And as we can see, every time price reaches these areas, it creates a resistance, it gets rejected, support gets rejected, resistance gets rejected again, and it keeps going up and up. So that's what a trend channel is. Okay, and then we have the support over here. Like I said, price doesn't break it, and then we have the resistance, which is over there. Price doesn't break it either. Okay, so let me erase what I just did. Okay, then how do you trade the channel? That's the question. So what price tends to do is every time price comes down to these levels, you could buy the channel. So basically, every time price reaches a support, which is at the bottom of the channel, you can take a buy position. You just need the confirmations to get the buy. So as you can see here, there was opportunities here, and even more. You could take the sells too, but it's not recommended, especially when it's an upwards channel. You always want to go with the way the trend is, which is bullish in this case, and it's always buys. Okay, now we're going to be talking about downwards channel. Excuse me for this, it's an error. Anyways, okay, so price creates lower lows and lower highs because it's a bearish trend, and when it occurs over a period of time, price creates a channel again, which is the same one as the one we've seen before, but in the opposite direction. Instead of going up, we'll be coming down. So price obviously going to have support and resistance levels again, which, as we can see here, price is creating lower highs and lower lows, lower highs again, and then lower lows again, and the trend keeps on going. In that case, as we can see here, every time price comes to this level, it gets rejected, bounce off of it. Same thing when it comes to the resistance. So these two, you always want to look for channels that look like this if you want to trade with the trend in a channel, which is very good, but at the same time you just have to make sure that you're taking trades with confluence with other confirmations. Okay, how would you trade this? So the same as we said before, every time price reaches the top of the channel, which is opposite what we said when we reach the bottom, we take buys. Now when we reach the tops. So what I'm saying is this: we know that we're creating lower highs and lower lows. So if we create this lower high, that means we have to create a new lower low to keep moving down. And if we create this lower low, that means we have to create the new lower high, so price can keep moving down also, right? So that's the whole idea of a downwards channel or a bearish channel. Okay. Excuse me, I'm just having a hard time talking. I have my neck is hurting. Anyways, so as you can see here, price creates its lower high, we take a sell position again, another lower high, we take a sell position, another lower high, we take another sell position. This you could have taken it too, but the problem with this, it didn't go through the resistance area. So it's a bit riskier, but it's also possible to do it. Okay, we'll move on to the next. So we're going to talk about triangle patterns. So triangle patterns, you have two types of triangles. So the first one is going to be, so we have a descendant triangle, which is self-explanatory. It's a descendant triangle. We're going to be looking, it's going to be downwards, and then the second one is going to be ascendant triangles. So this is how they look like. So this is what a descendant triangle looks like. So a 90 degree, which you don't have to worry about this. But descendant triangle, so basically what price would do is, price will create the support, and then it will keep going down until it reaches this area, and then it will explode from there. The same thing with an ascending triangle, except opposite. Price will create resistance, and then it will keep moving up, and then reaches a point where price will explode. So let's talk about descending triangles. Descending triangle is a bearish pattern. Although you can see over here, yeah, we're going down, which is right. What happens here, we'll need to explode afterwards. Okay, how would you look for this? How would you want this to use this pattern to look for sell? So for example, we have this price action, right, which is just happening. So if you move on, so price will create the support which we mentioned before, support which is over here being created, rejections, rejections, and rejections, right? So that's the support, and then we would need for the downline, which is over here, as you can see. So that's going to be the slope, or whatever you want to call it. Okay, so that's going to be for a descending triangle, and then the question is how would you trade it? So that's going to be talked about after. Like I said before, the closer we get to the angle over here or anywhere, the stronger the move and the more valid the move is. If you can see here, price rejected, and then we have one bearish close. So when you have that, you just need to look for the confirmations to take sells, which is over here after the break of that support. Now let's talk about ascendant triangles. Ascendant triangle is a bullish pattern, which is opposite to the one before. How would you use this pattern? You would look for buy. So like we said before, we need to create a resistance. Which is right over here. So price rejected it and rejected again. Okay, so that would be your resistance that we just mentioned here. So that's our resistance, and then you have the slope, which price also failed to break. So rejections, and then an engulfing candle says that momentum has been shifted to keep moving up, and as we can see here, price just exploded for buy positions. So obviously you wouldn't take the trade right away, you would need to look for the confirmations on lower time frames, but that's the whole idea. As you can see here, you get the break, the retest, and then a big explosion, a big momentum shift, and buys were good. So next we have symmetrical triangles. Yes, you may say, yeah, but you just mentioned two, but they're not the same. This is different. This is, you can use this type of triangle in both bullish and a bearish pattern. You could use it either for buys or sells. Okay, for symmetrical triangle, you would need two different slopes. So we need the first slope, which is going to be a rising slope, and then the second, which is going to be a downward slope. So we look at this example. So we can see the price creating lower highs, higher high, lower high, and then higher highs, and then lower lows, lower highs, and then moving lower lows. So in this case, that's when you want to use a symmetrical triangle. So if we shift, we can see the first slope, which is an upward slope, which is saying that we are on an upwards channel. And then we have the second slope that says that there has been a shift in the trend. Okay, so like I said, like before, when price meets, as we see here, when price meets these areas, the impulsive move would be greater. So the closer it is to the angle or the edge, the more explosive the move is, the more impulsive it would be. So as you can see here, you get the break, the retest, the confirmations, and then you just take the sell and you ride the trend. Now we have head and shoulders. Yes, you may say it's like the shampoo, but it's not the same thing. It's not the one we're talking about. So head and shoulder is a bearish pattern, and then we're going to be talking about the inverse head and shoulder, which is going to be different. So for the head and shoulder, it's going to be a bearish pattern. For the head and shoulder to be formed, you need three inverse V's. So V's are usually look like this, right? But what we want is the other way around. We want it to form like this. So we want 3 of those, so we can form the head and shoulders. So the first one's going to be a big one, then the third one's going to be a bigger one, and then we have another one which is like this. It's going to be like a mountain basically. 2 small mountains, and then you have the big one right in between. So that's what the head and shoulders would look like, which is right here. So you can see the first one. Let me use my pen to clarify. So we have the first one, you have the head, the second, and you have the third, like I just mentioned before. And we can see that this is the head, and then you have the 2 shoulders, which are right here. It's like you should 2 shoulders on your head. Okay, so that's that. Now there's still more. So we need a neckline. For us to take sells, there should be a break in the neckline. You might ask yourself, where's the neckline? Well, the neckline is right here. You can see price came down, rejected it, went up, came down again, rejected it, and came back up again. As you can see, that the first and the third moves are very small compared to the second one. Well, that tells you that there's a momentum shift. We haven't changed momentum. So you would need a break, which is right here, with confirmations. There's going to be an example right here. As you can see, we had the initial move, first shoulder, came back down, created the neckline, then it created the head, which is higher. So as you can see, that's the first, that's the second, and the shoulders and the head is way higher. Then you have the shoulder after the second touch down here. Then you have the break. Let me erase all this so we can have it clearer. Then you have the break over here, and then you break, the retest, and the confirmations, and you take sells, and you should be fine with sells. Now inverse head and shoulders is going to be obviously the opposite of the head and shoulders, which is going to be a bullish pattern. So you're going to be looking for buys this time. So instead of looking for 2 inverse V's, we need 3 V's. Not 2, 3. So we need 3 V shapes. So as we can see here, that's the first V, the second V, and the third V. That's what we need to be looking for inverse head and shoulders. So as before, you have the head in the middle, you have the 2 shoulders on the 2 edges, on the left and the right, and then you have the neckline again. That's what you need to have an inverse head and shoulders pattern. To take buys, you'd obviously need to break the neckline and look for confirmations. So this is an example. So you have price moving up, and they came back down, create the first shoulder, rejections at the neckline, created the second, created the head, went back again, rejected again, and created the other head, the shoulder I mean. Over here, then we find a break. We see this wick rejected, or it was our confirmation, then we take the trade and we get buys. Or you could wait for a bigger move, retest again, and then take buys. Whichever you want. Like I said, it depends on your confirmations. Now we're going to be talking about double tops. I don't know why, although I made sure that it shouldn't be visible, but anyways. Okay, double tops are a bearish pattern, which is very commonly used. A lot of traders use them. They're pretty easy to understand and pretty easy to use. All you would need is for price to create an M shape. So this is going to be your 2 tops, and then when these 2 tops are made, there should be a resistance made from the first one, but the second one just to confirm that it's there, and you take a position after it. For that to be done, you must need to break a neckline, there's always a neckline in these patterns. So you have the neckline over here at the middle triangle of the M. Then you take just a sell position when you break the neckline and have the confirmations. You'll always need it doesn't matter which pattern you use, what type of style you trade, you always need confirmations to take positions. And then you just need to execute when you have the confirmation. So we have an example here. So price moved up, created the first top, neckline, the second top I forgot to draw the resistance, but anyways, you can see it from the rejections. Then you have the break, got the retest, and then you just take the sell position. Where you could take it here, you could wait for a retest, take it here, whatever you feel comfortable with. Okay, I have the same problem again here. double bottoms, which as you can see it's a bullish pattern, which is obviously going to be opposite to double tops. So instead of being an M, this time it's a W that creates two bottoms, the first bottom, the second bottom, which is here, which created this point a support instead of a resistance as we had before. Okay, in this case we would need the price to break a neckline, which we have right here. When price breaks a neckline, we must look for confirmations to take buys. After the confirmation, all you need to do is just execute, press the buy button, and you should be fine. For example, so we have first one, so that's the first bottom, the neckline created, the second bottom, then you have the break, then you have a big impulsive move that led to a big profit if anybody took it, and as you can see that's how it should look like on the charts. Now we have wedges or pennants, whichever you call them, doesn't matter. So there's two types of wedges. So you have the rising wedge and the falling wedge. So this is how the rising wedge looks like. So price is going to be pushed by a resistance and a support. So okay, so price is going to be moved. So price is going to be respecting the support, and going to be respecting the resistance also. And reaches this area, price will fall. It wouldn't rise because this is opposite. Although it says rising, it should keep moving, but no, because price is overextended, it will do a big impulsive move to the downside. And for a falling wedge, will be the opposite. Price will be respecting support and resistance at these areas, and when it reaches somewhere over here, price will move impulsively to the upside. So let's talk about rising wedge. Rising wedge is a bearish pattern, although it contradicts, but that's the fact. Anyways, let's move on. So as we said before, price is going to be squeezed by the support and resistance. So let's look at this example. We can see the price is moving up and it's being squeezed. You see how the candles looked? Candles were higher. Candles were big candles here. Then the more we move upwards, the smaller they become because they're being squeezed in a tighter space. And then when that happens, a big impulsive move goes to the downside, and that's where we take our sells. You can take sells here, wherever you feel comfortable with. Okay, when price is reached, which we just mentioned before, between support and resistance, we need a break, and then we take sells. As you can see here, let me erase all of this. As you can see here, price broke. We had this doji or a confirmation of the respecting the support, which became resistance. Then we just take the trend downwards. Now for the falling, which we said is opposite to the rising wedge, so it's going to be a bullish pattern. Price is going to be squeezed by support and resistance like before, but this time it's going to be in a downwards movement, not an upside. So if we look at it, the same idea: big candles, small candles, big candles, big candles. Then we keep getting smaller and smaller until we find a break over here. So as you can see, the tighter we got, the bigger the impulsive move it was. So let's do this. So in this case, you just need to wait for a break and a retest or any type of confirmation from the resistance for you to take a position. You could either take the position right away, which is going to be riskier, or you could just wait for a retest so you can have higher confirmation to take buys. And that will be it for this session for chart patterns. I mean, you could use them, you can implement in your trading plan. They should be very useful. You don't have to use all of them. You could use just one or two, double tops, double bottom, whichever you feel comfortable with. And they should make you more profitable, and just good knowledge to have in your toolbox, and you can use them anywhere, anytime. And with that being said, thank you all. I appreciate you being here, and we'll see you next week. Have a good one.